Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
You point the camera now to our first guest, Cameron Dawson of NewEdge Wealth, joining us right now to talk a little bit more of whether that lopsidedness that we saw at the start of 2024 is going to be lopsidedness at the start of 2025.
I think the most important point about breadth is that it actually has been supported by earnings. The reason why the market has been narrow, it's because earnings growth has been narrow. So it's not just valuation alone, and we've seen that in the last 4 months. If you look at the Mag 7, their earnings estimates have actually been revised higher by about 15%. But if you look at the equal weight index, their earnings have been revised lower by about 5%. So that spread in earnings revisions and earnings strength is really what has been driving the fact that this market is led by such a few short names. The question is, if you look at estimates in 2025, they have the everything else starting to really participate in earnings, but that's a pretty high bar and pretty much a show me story as we get into next year.
How much, if we do get a broadening of the earnings picture, how much of that is dependent on economic conditions and, for that matter, policy conditions coming out of Washington?
It is rather peculiar that we've seen this economic growth environment where we've had consistent upside surprises to growth. We've had growth be above trend, and yet it has not materialized to the everything else earnings, meaning that you've had this strong GDP environment, but the average stock has continued to struggle. Part of that is just an overhang from the pandemic. You had some over-earning that happened. Margins got overextended, and that was coming back in. But what you have now is this expectation that you'll have a huge reacceleration in those 493 names. We're not sure if you get that in a potentially decelerating nominal growth environment.
You know, it's a little earlier that Romaine had mentioned the bond market. You're seeing that bid come back into the bond market in the last week of the year. However, just last week, we were at 461. Again, on the 10-year. At what point does that start to get in the way of this equity market rally, or is it already getting in the way?
The thing that's been most surprising in 2024 is how much we've been able to see multiple expansion despite having rising bond yields. If you look, forward multiples for the S&P 500 are up about 17% over the course of the year, and that's with a bond market that has seen this constant pressure and rising yields. So at a certain point, is a 22.3 times forward multiple consistent with a bond yield at 4.6%? We always have to remember that valuations are a very poor timing tool, but we're getting to a point where equity risk premiums are incredibly narrow, incredibly tight. So as equity investors, you're not necessarily getting well compensated for the added risk.
But even if you believe that the reason yields are higher is because of strong economic data, then does that mean that any vulnerable economic data could set the market a little haywire?
I think that is a really good point, is that if you're looking at things like credit spreads being ultra tight, valuations being so high, it's not contemplating any kind of growth slowdown. So if you were in an environment where you're seeing growth estimates get cut versus getting raised, that would be a challenge to valuations. We think the most important charts over the last 2 years is GDP estimates for 23 and 24. It has been a constant climb upwards. And if that starts to go in the other direction, meaning we're talking about GDP estimates needing to be revised lower, that's a very different market mood.
I am curious, though, too, when we talk about the expectations for economic growth, and we've seen what the market expects, what economists expect, we've even seen what the Fed expects. It's healthy. It may not be, gangbusters, but it seems like a healthy enough foundation. So why is there still some trepidation in the market, particularly when it comes to, like I said, mid caps, small caps, the types of companies that would benefit from a stable economic environment?
Well, I think first on the economic growth expectations is that recession risk has been effectively completely priced out of the market.
I forgot forgot about recession.
Does that happen? But also it's been priced out of the psyche.
Yeah.
If you go back to Powell's comments from a couple of weeks ago, he talked about how great the economy was and how optimistic he was about future growth. So if there's one thing...
Did you believe him?
Well, it does make us a little bit nervous if we're not considering any kind of downside risk, mostly as we're starting to see some signs of things like continuing claims last week continue to march higher. When it comes to small caps and mid caps, we have to acknowledge that it really is about the balance sheets. It's about interest rates being so high, and that there was this notion of survive until 2025 because Powell is going to bail you out. We're going to get interest rate cuts. If those don't come, then we have that balance sheet interest cost pressure that remains.
So in the realm of stocks, and if I say the word value to you, what does that even mean right now? Is there value to be found in this market?
Value isn't necessarily dirt cheap at this point, but we do know that the relative performance has been so abysmal that it's likely primed for some kind of snapback. Jeff DeGraff pointed out this morning that the value relative performance has been in about 6th percentile, so very, very depressed. The question is, does that start to rotate in the other direction that is sustainable? And that's where it comes back to earnings, meaning that you can see a snapback in value simply because it's underloved and underowned, but is that snapback lasting more than, let's say, 2 weeks? And that really is when it comes down to the earnings line, because those have to deliver for it to be more than just a flash in the pan.
You know, speaking of value, a lot of investors have been trying to rotate out of those high flyers, those big tech stocks, out of NVIDIA, for example, and take on...
Not NVIDIA.
Not NVIDIA. You have seen some of that pullback here and there, but, you know, if you think about the way that people are rotating, there is not a consensus. You've seen that small cap trade. You've seen some value. You've seen some rotation into different sectors as well. How do you play it? What is the most sustainable rotation at this point?
We think it's the steady hand of quality that remains still very, very important. Over the last 4 months or so, you've seen a big surge in low quality, high beta, high momentum kinds of names. And so we do think that the best way to be able to take advantage of these rotations is to continue to focus on things like high free cash flow, good return on invested capital, good balance sheets. They're getting left in the dust a little bit recently, but we do think over the long term that quality is the way to go.
It's people pulling out their EQS screens on their Bloomberg terminal and running those terminal charts. Hey, listen, do you want to go back to something you'd said earlier about GDP growth? Because so many investors are looking here at the way the Trump administration will tackle, of course, the reorganization of the government. Now we're talking about DOGE more and more on this program, aren't we? And do you believe that that could cut into growth if we don't see the same type of fiscal stimulus that we've seen the last couple of years?
I think it's a really important point, which is that fiscal has been a big contribution to overall GDP growth. And so if you start pursuing something that looks like austerity, it might be beneficial in the long run if we want to talk about budget deficits and balanced budgets. But in the short run, there is pain that you have to have for that gain. So it could be that if we actually are able, and that's a big if, to rein in some of the spending and do some reorganization of government, that could detract from overall GDP growth. We saw that the last time we went through a balanced budget kind of outlook. Post-sequestration, it was a drag on growth. So it is an important watch point.
Yeah, and it's a good point, too, because I think a lot of people kind of forget just how much government spending contributes to the growth of the economy. And it gets to this idea as well about the kind of bifurcation, how you have kind of a higher-end consumer, if you will, higher-income people, I should say, that appear to be doing well. You have people in the middle and the lower end that, at least anecdotally, still seem to be struggling. And there was some interesting data that we just got out today about credit card delinquencies rising, particularly amongst lower income folks.
It is still very present that we have this K-shaped economy. And if you think about the lower income consumer, they're sensitive to things like interest rates. They're far more sensitive to inflation, and they're more sensitive to the job market. So the fact that you're seeing hiring start to slow down, that likely is what is creeping into those issues that we're seeing with the delinquencies for the low income consumer. Then if you shift to the high income consumer, that's where we think the equity market is really important, because that's been one of the things, loose financial conditions, high interest rates, yet really strong stock prices, strong housing prices, has led to the high-income consumer being so resilient. And good to remember the top 20% of consumers make up 40% of overall consumption. So they outpunch their weight. And so if you start to see equity market weakness, and that's an if, but if you start to see it, that could be one thing that could cause that high-income consumer to begin to pull back.
I should just point out, I did my economic part this holiday season. I haven't seen my credit card statement yet, but I'm sure it'll make me weep when I get it.
Yeah, I'm not excited to see it. The holiday seasons are always tough. You know, the credit card delinquencies are a great point. The other reason to look at them is because weeks away we have earnings season starting once again. And if you're starting to see credit card delinquencies rise, do you start to worry about the banks again, or do you shrug it off because the yield curve is steeper and rates are staying high?
Yeah, it's a really good question. Is that there's also this notion that the banks are going to see the benefit of a big IPO and M&A cycle. That could be a bit of a hope. We are seeing good performance out of recently IPO'd stocks, at least over the last couple of months. So maybe that's something that can defrost the ice that has been present for the last 2 years within that part of the market. But I think it is an interesting point, which is that markets have effectively priced out some of this credit risk, saying that the economy is strong, so we don't need as much compensation for credit risk. But you're starting to see some pockets of weakness. And if rates remain high, we can't forget that you have a big refinancing cycle that starts in 25 and into 26, and maybe that starts to pinch some of these borrowers.
All right, Cameron, I'm going to have to leave it there. No better way to close out the year than a conversation with Cameron Dawson, the CIO over at NewEdge Wealth. Joins us right now to talk a little bit more about his outlook for energy prices. And it's kind of a big contrast to what we saw at the start of 2024 when we had that 10-15% rally and everybody was talking about oil at $100 and beyond. And we've come a long way since then, just not in the right direction. Well, not in the right direction if you're an oil producer.
Yeah, that's right. I think the bulls have been chased away, at least for now. And under the President Trump's mantra of drill, baby, drill, I think it may be another challenging year, at least for oil. Keep in mind OPEC's production cuts, keeping about 5 million barrels a day of spare capacity offline. That's where some of the downside risk potentially comes. Now, I don't necessarily believe that OPEC's going to open the spigot back up in April. That's what they've delayed their restoration to for now. But I think it's going to be another challenging year for the upstream, whereas you still are going to see your seasonal swings when it comes to the midstream, the refiners. Maybe good news, though, for pipeline operators who may be able to expand a little bit more readily available. And then the retail sector. I think the C-store level is going to experience another good year. But for oil, there aren't a whole lot of upside risks now. I think there's more downside potential than upside for 2025.
Just staying on oil for 1 second, particularly on the production side, because I know there was a lot of optimism about the Trump administration coming in, particularly given the policies we saw the first time around. But there is an issue of capacity right now, and whether there is anything to drill, baby, drill into that we haven't already drilled, baby, drilled already into.
Yeah, I mean, exactly right. The Permian has been maturing. Now there's been talk about potentially reopening the Arctic wildlife refuge. So, that's something there as well. But I don't look for oil companies to go into rural Alaska and to be really excited about potentially drilling there. I think there's a lot of challenges with that. And keep in mind, getting that oil online could take potentially years, if not longer than that. So the Permian is slowing down. So there potentially is some upside there. But keep in mind, OPEC's spare capacity, Guyana as well, seeing a huge increase in capacity. I think one of the wild cards in terms of risk, keep in mind, is that Canada sends us over 4 million barrels of Canadian heavy oil every day through a couple of different pipelines. And of course, President-elect Trump's promise on tariffs. Well, I think that I'd like to fall that under his talk, but you never really know. And again, President Trump's kind of against the status quo, at least on some of these issues that do pose a potential upside risk for oil in the year ahead.
I want to go to your outlook for 2025, but first, can you just reflect back on the year that was in oil? WTI basically flat for 2024. What was really driving that, lack of movement?
Well, on the supply side, OPEC had been taking barrels out of the market. There wasn't a whole lot to get excited on the demand side of things. China's economy has been incredibly weak. Not only that, but they've been pushing EVs much harder. And keep in mind that their gasoline demand may have already peaked now moving forward. And so Chinese demand is a huge headwind for this market. And it comes as there's a lot of supply that remains offline, and the U.S. is back at producing record amounts of crude oil ourselves at about 13.6 million barrels a day. So I think a lot of this story is really focused on the China economy that really has struggled for much of this year. Now there's a promise of stimulus moving forward, but there's simply too many spare barrels sitting offline here for the market to really see much of a run-up. Now, I think we could see a bit of a spring surge. That may be tied more to refined products, but we'll have to keep an eye on the U.S. economy. I mean, there's a lot of potential possibilities that could slow our economy down, which in turn could also slow down global oil consumption.
How do you think about inflation for 2025? Because at least at the Federal Reserve, the FOMC members did up their inflation projections. How do you kind of take inflation into your forecast?
Well, as you indicate, I mean, a year ago, we were sitting here talking about waiting for the Fed to cut interest rates rather aggressively. And now they've really toned that down. And now there's more caution in their statements. And that could pose a negative for oil as well. I don't think oil or energy is going to be inflationary in 2025, but it's obviously a risk factor. If the Fed slows down its interest rate cuts, there could be ramifications for the dollar. And of course, the dollar right now has been fairly strong. So keep in mind that oil is globally traded in dollars. That could even have an impact on the price of oil, and certainly something we'll be watching in the year ahead.
I am curious, Patrick, and maybe if we can circle this back to the consumer. There was obviously a lot of talk during this election cycle about gas prices, despite the fact that, at least as of today, gas prices at the pump are about 40% lower than where they were, I think, about a year ago or so. It gets to the question here as to whether we see prices at the pump, at the retail level, kind of remain where they are, maybe even go lower, or are there some forces out there where maybe we should prepare ourselves for higher prices ahead?
Well, I think for consumers, it's going to be a third year straight of declines. Ever since 2022, the yearly national average, again in 2025, likely to trend lower. Now, consumers shouldn't mistake that for flat gas prices through the year, because we will see gas prices start to go up as we get closer to warmer weather. By the way, according to GasBuddy data this morning, one of those rare moments where the national average has slipped below the $3 a gallon mark. I do think that will be temporary. And in the spring, we will see that surge. Prices will probably run up 25 to 50 cents a gallon, and they could get closer to the mid and upper $3 mark. But that's going to stop short of what we saw last year when the national average peaked at about $3.67 a gallon. So it's good news for consumers. They probably won't be shelling out as much in 2025. But keep in mind, President Trump's promise to cut energy prices in half, that's a big difference. Talking about prices at $3 versus his promise of cutting them in half, which would represent a price below $2.
Yeah, something we haven't really seen on a sustained basis, probably since I was in diapers. Patrick, I am curious about this idea of an export economy for our energy. We've obviously seen the U.S. over the last few years become energy independent, and of course now has a relatively thriving export business. How much can that expand based on our own demands here locally, and how much is going to be left over to ship out and sell to other folks overseas?
Well, I mean, you're looking at U.S. exports. A lot of that is lighter, sweeter crude oil. And really the bigger boom is LNG. And that's what certainly could expand under President Trump. The exports of LNG, I mean, he's already threatening Europe that if they don't buy additional U.S. energy, that there's going to be ramifications. And I do think there's room to grow. Well, natural gas prices have been blossoming here in the last couple of months on the promise of potentially more exports. Natural gas now above the $3 mark. So I think there is room to grow. The U.S. is the world's largest energy producer, and I think we'll probably see that continue to grow in the years ahead, especially as Russia continues its war in Ukraine and Europe continues to turn to the U.S. So I think there's a lot of promise in U.S. exports, and again, look for exports, especially of LNG and crude oil, to continue increasing this year as countries potentially make the shift, and as President Trump may push countries to make the switch over to U.S. energy.
Patrick, what geopolitical risks are you looking at for 2025 that could potentially pose a risk to your forecasts?
Well, again, I think President Trump is a bit of a wild card. What he says and what he does, it's a little bit against the status quo to come out and, talk about potentially putting tariffs on oil and other things, everything really from Canada and Mexico. So the political relationships could shift in the years ahead. And keep in mind, China, still a really big one. How they're shifting away from fossil fuels is a big turning point here. They've potentially already seen peak consumption. We turn to India to see growth there as well. So, and there's a lot of geopolitical issues. The Middle East has been quieting down, but there's still the potential of conflict there, and Russia's invasion of Ukraine, certainly something to keep an eye on. But I think geopolitically, with somebody like President Trump in the White House, he may strong-arm other countries into potentially doing what he likes a little bit more, and that certainly could keep energy prices from climbing much more substantially if he uses that strong arm frequently.
I'm curious, do you think there will be any sort of meaningful global coordination on some of this? Obviously, we know OPEC Plus has its own cartel, but in the past we have seen cooperation, for lack of a better word, among some of the other major oil producers that aren't in OPEC in dealing with OPEC, or is just the relationship so fractured and so disparate right now that investors shouldn't pay any attention to that?
Well, I think it is certainly fractured. I think there's dissension amongst the ranks at OPEC. I mean, we've already seen some of that. Some countries certainly want to raise production. Saudi Arabia and Russia kind of going against that, trying to hold the line. The Saudis are spending a lot of money, and they have a lot at stake here if oil prices were to decline even more significantly. So there's certainly some driving factors. But again, some OPEC members do want to increase production while others do not, and that's something to keep an eye on. OPEC is certainly not as coordinated as it once was.
All right, Patrick, great stuff. Patrick Haan over at GasBuddy. Terry Haines of Pangaea Policy joins us right now to help reflect on the life and legacy of Jimmy Carter. A lot of important dates there. We talk about January 9th being a day of reflection and remembrance. Of course, his birthday, October 1st, back in 1924. His death, of course, on December 29th. But I want to start, Terry, with July 15th, 1979. That was the day that Carter gave that famous malaise speech. And just a few weeks after that, appointed Paul Volcker as chairman of the Fed to fight what at the time was just an almost unprecedented level of inflation that this nation was facing, a level of inflation that for years he didn't necessarily get credit for taming.
Oh, I think that's absolutely true, Romaine. Good morning to you and Critty. I think it's absolutely true. I said to markets this morning, I think they should all thank and remember Carter for the crucial role that he played in breaking the back of inflation over several years. I mean, that was as well as not only appointing Paul Volcker, but defending Volcker personally and Fed independence through his term, something which President Reagan also did at no small political cost to Reagan, even though he eventually got the benefits out of it. That set the stage for not only the great markets runs that we've seen, even through great geopolitical crises, health crises like COVID, a bunch of other things, but also set the stage in helping the United States win the Cold War by boosting the relative economic strength of the United States against the Soviet Union at a crucial time.
It's kind of interesting to read some of the biographies of Carter, particularly some of the ones that have come out over the last decade or so that have really painted him, I think, in a much better light than maybe how the country viewed him back in 1980 when he lost to Ronald Reagan. And I am curious that if it weren't for the hostage crisis in Iran, the oil embargo, and of course the level of inflation, is it possible that he might have been reelected in 1980?
Oh, sure, absolutely. The President Reagan's run, the then candidate Reagan's run began fairly late, and Carter was absolutely bedeviled by a lot of these policies. I've met President Carter, but I was privileged to know a lot of the people that were his senior aides, most prominently, including Jody Powell, who I knew decently well, and so got a window into a lot of these things. And Carter's strengths turned out also to be some of his weaknesses. The mulishness and commitment that he showed to Volcker, which made such a huge difference for the country, even today, was also in large part what helped bring him down. He had a split in his own party that led to a primary challenge from Ted Kennedy. He had a revitalized right under Reagan that ultimately swept him out of office, and he also was guilty of probably too much candor in talking to the American public about things like malaise that you bring up that led to the impression that he was either out of control or unable to respond effectively.
So, Terry, that's a lot of the domestic story. Let's talk about his record internationally, his foreign policy record, the Camp David Accords, his role in the Panama Canal, even boycotting the Moscow Olympics as well. These are all flashpoints that are just as relevant today as they were during his tenure as president. What does Donald Trump take away from that? Are there lessons to be learned?
Absolutely. And the first lesson to be learned, I think, is that the presidency has limits. Every victor in a presidential campaign, and the people around him tend to be a little triumphalist. They all want to talk about legacies mandates and the like. Clinton came in 92 talking about a mandate when he had basically won 43% of the vote. There's always a lot of salesmanship that are involved in it. But the lesson you can learn from Carter's presidency and a lot of presidencies, frankly, is that the presidency has limits, and it's wise to remember those even while you're trying to maximize your political benefit in the moment. What Carter's presidency showed really was that he found it very difficult to bring his own congressional party along with him. Congress is a co-equal branch of government and acts like it, and he didn't. And Carter's also, while president, did not bring the public along with him as much as try to lead public opinion, and that also came back to bite him. So it's a balancing act with presidents, and any president after Carter was wise to remember that.
Terry, we talk a lot about energy security, and we certainly did in the context of the oil embargo during Carter's time as president, but we're also talking about it now in terms of tariffs, in terms of what's going on in the Middle East, and the idea that the United States is the largest energy exporter in the world at the moment. What does that mean for the here and now? When we're talking about modern politics, is that a good thing, or is that a bad thing for the United States?
On balance, I think it's a good thing. I mean, we have strengths and weaknesses geopolitically, but one of our geopolitical strengths is energy and energy export, and we are in a situation now where we're in the most difficult geopolitical risk situation in more than 50 years. So it behooves the United States, no matter who's president, frankly, to make sure that it uses its advantages wisely, but that it maximizes those advantages as well. Certainly energy is one of those. And, I'd frankly look to the next administration and President Trump personally to try to do everything possible to maximize that advantage.
Let's talk about President Trump, the 47th president, his inauguration on January 20th. What is his relationship going to be like with world leaders, particularly in contrast to kind of what we saw with Carter back in the 70s? I know they're two completely different people with two completely different agendas here, but are there any parallels that we can draw?
Oh, absolutely. I think Carter had, Carter had a very fractious relationship with many countries in the world. His China policy was very successful, but on the other hand, even coming up with the Camp David Accords required that kind of hard-headedness, that mulishness that I lauded him for earlier on monetary and economic policy, and he succeeded in that. He did not shrink from confronting world leaders in a way that he tried to push the benefits of peace and United States hegemony. Frankly, this is a different world, but Trump has that same broadly kind of push-pull relationship and fractiousness. It's going to be the thing I would just say to President Trump is, a spoonful of sugar will really help a little bit. He's been largely succeeding in pushing allies towards greater defense spending and a variety of other things. He can continue that, but it's going to take a little more. It's going to take some finesse, and he's shown the ability to at least understand that, and that's a good thing.
Terry, appreciate you coming on. Obviously, we had a totally different conversation planned for you, but really great to get your insights on the life and legacy of Jimmy Carter. Terry Haines there of Pangaea Policy.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.